What if you could instantly slash your taxable income by 20%, saving thousands of dollars this year alone? Most real estate investors miss out on this massive tax break, but in this video, you'll learn how to claim it and keep more of your money where it belongs, right in your pocket. Stay tuned to discover exactly how. The Qualified Business Income Deduction is a powerful tax-saving tool designed for business owners, including real estate investors. It allows you to deduct up to 20% of your business income, effectively reducing the amount of income you're taxed on. If you're involved in a qualified business, like a sole proprietorship, LLC, S corporation, or partnership, you could be eligible. This deduction can make a significant impact by lowering your taxable income, which means more money in your pocket at the end of the year. For real estate investors, rental income and management fees usually qualify. Taking this deduction can save thousands of dollars on taxes every year, freeing up more capital for further investments or personal use. The key is to ensure your business income meets the criteria set by tax law, so you don't miss out on these savings. Now that you know how powerful the QBI deduction is, let's see if you qualify for it. Who qualifies for the QBI deduction? To qualify for the QBI deduction, you need to be running a business that meets specific criteria. Eligible business structures include sole proprietorships, LLCs, S corporations, and partnerships. If you own or operate one of these entities, you might be in a great position to claim the deduction. However, there's a key factor to consider. Your income must come from a qualified trade or business. A qualified trade means you are engaged in a regular, ongoing business activity that isn't classified as a specified service trade or business, like law or healthcare. For real estate investors, this generally means rental income or property management fees are likely considered part of a qualified trade. Many people miss out on this deduction simply because they don't understand the eligibility rules. They either think their business doesn't qualify or aren't sure if their income counts as qualified business income. If your real estate activities are structured correctly, you likely meet the requirements. This deduction could save you a significant amount in taxes, but only if you know that you qualify and how to claim it correctly. What is qualified business income for real estate investors? Qualified business income for real estate investors refers to the income you earn directly from your rental properties or real estate business. This typically includes rental income and property management fees. If you're actively managing your rental properties, handling tenant needs, or overseeing operations, this income usually qualifies for the QBI deduction. However, not all income related to real estate qualifies. For instance, capital gains from the sale of a property, interest, dividends, and other investment-related income are not considered QBI. These types of earnings don't come from ongoing business operations, so they aren't eligible for the deduction. There are some exceptions to be aware of. If your real estate activities are classified as a specified service trade or business, such as offering financial or consulting services, this income may not count as QBI. The key is that your income should come from the active running of a business, not passive or investment activities. For most real estate investors, rental income will qualify, making the QBI deduction a great way to lower taxable income. Now that you know what qualifies as business income, let's explore how real estate investors avoid being excluded by SSTB rules. What is a qualified trade or business, and how does the SSTB exclusion affect real estate investors? A qualified trade or business is any business actively engaged in generating income, except for a few exclusions, such as certain service-based industries. For the qualified business income deduction, your business must operate as a sole proprietorship, LLC, partnership, or S corporation, and the income you earn must come from regular business activities. However, not all businesses qualify. Specified service trades or businesses are excluded from claiming the QBI deduction. These include fields like health, law, accounting, consulting, and financial services, businesses that provide personal services rather than products or operations. If your business falls under this category, it likely doesn't qualify for the QBI deduction. For real estate investors, this exclusion raises some concerns. Real estate activities typically don't fall under the SSTB category, so they usually qualify for the QBI deduction. Income from rental properties, property management, or leasing activities is considered part of a qualified trade or business, as long as it's not classified as a service-based business. However, if a real estate business provides consulting or advisory services, it could risk being classified as an SSTB and lose out on the deduction. Fortunately, the IRS has provided exceptions for real estate investors. For example, property management services, operational work related to real estate, or even certain educational courses related to real estate may still qualify for the deduction, even if they seem service-based. As long as the income is tied to the active operation of real estate assets, it generally won't be classified as an SSTB. This means that most real estate professionals, particularly those involved in direct property management or operations, can avoid being categorized as an SSTB and claim the full benefit of the QBI deduction. Let's move on to the income limits and how to calculate your QBI deduction. Income limits and how to calculate your QBI deduction. When claiming the QBI deduction, it's important to keep an eye on your income levels. If you're a single filer, your taxable income must be below $165,000 to fully qualify. For joint filers, that threshold is $330,000. Once your income exceeds these limits, the deduction starts to phase out. If you're above these thresholds, but not by much, the deduction is reduced. However, if you earn far above these amounts, you might not be able to claim the QBI deduction at all. As a real estate investor, understanding these income thresholds is key to maximizing your tax savings. It's crucial to monitor your income to see where you stand and how much of the deduction you can claim. Now, let's break down how to calculate your QBI deduction. For most real estate investors, the deduction equals 20% of your qualified business income. If you don't have any W-2 wages from your business, you'll likely use this straightforward 20% calculation. However, if you take wages from your business, the calculation becomes a bit more complex. In this case, you'll need to take the lesser of 20% of your QBI, or 50% of W-2 wages. For real estate investors who own property, there's another method. You can deduct 25% of W-2 wages plus 2.5% of the unadjusted property basis. In most cases, real estate investors will rely on the 20% QBI deduction. However, if you have W-2 wages or own qualifying property, you'll need to take these additional factors into account. By staying mindful of your income level and the deduction rules, you can optimize your tax savings each year. Now that you know how to calculate it, let's go over the steps for filing and a strategy for high-income earners. Filing your QBI deduction and strategies for high earners. To claim the QBI deduction, you'll need to fill out Form 8995. This form is straightforward, but you'll want to ensure you have all the correct details. As a real estate investor, you'll need to report your total qualified business income, any W-2 wages you've paid, and the unadjusted basis of property you own. Be sure to double-check your income calculations and any wages related to the business to avoid common mistakes, such as misreporting income or failing to include eligible expenses. A frequent error is not properly classifying income, which could lead to missing out on the deduction entirely. It's also important to ensure your business structure is eligible for the QBI deduction. For high earners who exceed the income threshold, there's a tax strategy that could still help you qualify. One method is to create a separate corporation to provide services to your main business. For instance, you can pay this separate entity for services like property management or maintenance, which reduces your taxable income in your primary business. By doing so, you can lower your business income enough to stay within the QBI threshold, allowing you to claim the deduction. To avoid losing out on the QBI deduction, here are some common mistakes and how to avoid them. Common mistakes and how to avoid them. When claiming the QBI deduction, real estate investors often make a few common mistakes that can lead to lost savings. One major error is not fully understanding whether their business qualifies. It's crucial to confirm that your real estate activities are considered a qualified trade or business under IRS rules. Another common mistake is miscalculating your QBI or forgetting to include all eligible income. Rental income and property management fees usually count, but things like capital gains and dividends do not. Missing eligible income can reduce your deduction, so be thorough in your calculations. Filing errors are also frequent. Using the wrong forms or overlooking necessary deductions can can disqualify you. Make sure to use Form 8995 and report all relevant information accurately. To avoid these pitfalls, stay informed about QBI rules, keep detailed records of your income, and double-check your filings to ensure you're maximizing your tax savings. What's the biggest challenge you face in maximizing your tax deductions as a real estate investor? Drop your answers in the comments below. Don't forget to like, share, and subscribe, and hit the notification bell so you never miss out on our latest tips.